Pepsi is down nearly 3% today and 8% just over the last 30 days, and we can already see one strong buy rating and a buy from Wall Street. So is this now undervalued, one we need to consider for adding into the portfolio? As always, we're going to do our deep dive. We will touch upon the dividend safety amongst other underlying financial metrics. We're also going to look at insider movement. We do note some insider selling over the more recent quarters, as well as getting up to date with what the institutions are doing, not just over the last year, but also on a more quarterly basis. And what we also want to add into our analysis today is compare how it has performed historically over the S&P 500, whether or not, in fact, over the longer term, it may just be better to dollar cost into the S&P rather than look at an individual stock. We'll also look at Pepsi in comparison to others in the industry to understand whether or not we do see this as a long-term guarantee for great gains in the portfolio. And we want to understand the numbers, their top line revenue growth, as well as their bottom line net income. And we also want to see the health of this company, their total cash versus their total debt. Don't forget as well, as part of our analysis, we will run it through the valuation model. We want to get to our intrinsic value. We want to get to our acceptable buy price, given our investor margin of safety. And we also want to see what are Wall Street, who consider PepsiCo a buy for the portfolio, percentage upside over the next 12 months. What exactly are we looking at? So let's start off with the historical performance of this company. And we can already see over the last 30 days, it hasn't had the greatest performance. When we extend it year to date, they are down 2%. Over the last year, down around 7.5%. And if you're a longer term shareholder, as you can see here, it is up around 91%. Do bear in mind that if you reinvest your dividends, it would be up slightly higher. And we do know all-time highs not too long ago, just below $200, 2023. In terms of the price, as we said, it is right there in the mid to lower end of the 52-week range. We do have a strong buy rating, a buy from Wall Street, and a hold from Seeking Alpha. And we also note the forward yield, 3.17%. And as we're about to find out later in the episode, this is above the 5-year average. And we can see a forward P just under 21. Bear in mind the S&P 500 now does sit around 22. So let's jump straight into the analysis. We will take a look at the numbers on the top line. And as always, when we do look at the majority of companies on the channel, 3 to 7% baseline growth as a minimum. 67 billion reported 10 years ago, December 2014. Latest annual accounts around 91.5 billion. So we can see there around 40% growth over the last 10 years. And when we do take a look at it graphically, it has been increasing over the longer term. But do note some years there is some inconsistency as well as very minimal growth. So we will take a look later on in the episode at this analysis, but in percentage format. In terms of the bottom line, what is the story to be told? Well, 6.5 billion reported in 2014 net income. We can see around 9.1 in their latest annual accounts, and it has pretty much followed the same growth as the top line, around 40% increase from 2014 to 2023 that we see here. And again, very similar, whilst it has grown over the last 10 years, year to year we can see some increases as well as some decreases. So lots to take in there. Do factor in that this can be used as part of your margin of safety when we do come to the valuation shortly on the episode. In terms of the health of the company, a quick health check, total cash and short-term investments versus total debt. 8.7 billion in 2014, 8.4 billion in their latest report. So their cash position hasn't moved over the last 10 years, but we can see within the last 10 years, there is movement year on year again. Now, what this 8.3 billion means, it doesn't really have anything in singularity, but when we do compare it to that balance sheet, we do want to factor in that total debt movement numerically and directionally. 29 billion in 2014, 46 billion in their latest quarterly report. So whilst their cash has barely moved over the last 10 years, their total debt has increased quite significantly, and this is always very important when we do come onto that dividend safety part of our analysis, as well as the supporting metrics for this. So we can also see over the longer term, their total debt is moving in that direction, increasing over the long period. And this is something we do need to factor in when we are considering this company. We don't want companies that take on a lot of debt and continue to see that debt increase year on year. Now, in terms of their earnings, how have they performed against analyst targets as well as future expectations? Well, over the last 4 quarters, yes, it isn't a very large population, but they have beat exactly 4 out of 4, so a 100% track record over the last 4 quarters. Nice to note, over the next 4 quarters, we are seeing growth mid-single digits to around high single digits. We can also see double-digit increase, and if you do factor in their EPS estimates of 8.83 in 2025, the forward P does look to sit around 19.37. So great track record. Also, the growth over the next 4 quarters does also look good, given they have beaten the last 4. Hopefully, we can see this continue over the next year and beyond. When we then take a look at our valuation grade, so the first one that we're looking at, the underlying metrics alongside, they get a D+. One thing to note then, a P on a non-GAAP basis, as we saw earlier, 21. Sector median, lower, 17.49, so PepsiCo is trading around a 20% premium. Again, we'll get on to whether or not this is actually justified and warranted through their other underlying metrics. When we take a look at the others, we can see, for example, on a price to sales, 2.49, again higher than the sector median, and you can say the same again for the price to cash flow on both a forward-looking basis as well as a trailing 12-month basis. So overall, this is a company that does trade higher than the industry as a whole, as we can clearly see, and that is why they get a D+ rating. But again, through our analysis, we need to understand whether or not this is warranted, and we should be paying a premium on the sector for PepsiCo. Now, in terms of the growth grade, well, they do get a C in terms of revenue growth year on year, 4.36%, so that is low single digit, as we can see, pretty much in line with inflation. Sector median is slightly lower at 2.56, and the same can be said for the forward expectations, 4.6 versus 3.8, around 22% higher than the sector as a whole. Now, one thing that I do quite like to draw your attention to is the expectation of the earnings per share growth year on year for the next 3 to 5 years. 6.88% versus the sector median of 8.18 is quite poor when you do look at the other metrics. They are trading at a higher PE than others in the industry, so do bear that in mind. Again, it does come down to whether or not the other companies do hit this target of 8.18. We then move on to the profitability. Nice to note some strong ratings. Finally, in A+. Gross profit margin, well, 54%, much better than the sector median at 35%, and the same can be said for the net income, the bottom line, 10% versus 5%. On top of that, what is also nice to note with PepsiCo, no surprises, their cash from operations very high, just under 13 billion, giving them an A+, as we can see, others in the industry below 1 billion. So in terms of a conclusion for this part of analysis, we have 2 buy ratings, in fact 1 strong buy, and then we have 1 hold, a D+ on the valuation, a C on the growth, as well as an A+ on profitability. Now, what I quite like to do is very quickly compare how they've performed against others in the consumer staples. We have Coca-Cola, Monster Beverage, Dr. Pepper, a lot of these that we have consistently reviewed on the channel every few quarters. In terms of total return, so including dividends reinvested, over the last 12 months, PepsiCo, one of the worst performing, down 5%. And remember, reinvesting those dividends, if you had done the same with Coca-Cola, you would be up, although marginal for a year period, 9.04%. When we extend this over the last 5 years, we do see, in fact, they are one of the better in terms of the percentage, 43.71, not too far off Coke, around 44.36 as well. But generally speaking, you do want to look for much higher returns over a 5-year period than in the low 40 percentages. In terms of the last 10 years, well, they have performed very strongly, 155%, a lot better than Coca-Cola. But in fact, in this industry, we do see others that have performed even better. You have Monster Energy up 348%, Keurig Dr. Pepper up 358%. Now, all these signals is past performance. It has no impact on the future performance, but we do like to take a look just to see historically how well they've performed. Again, whether or not you want to include this in your own investment thesis, the information is on screen. Now, we just want to have a look to see how they performed against the S&P 500, and year to date, we can see it has performed much worse off, only up around 2%, S&P up around 12%. Remember, both of these includes dividends reinvested. Over the last full year, we see Pepsi, in fact, down negative 2%, S&P significantly better. Over the last 5 years, in fact, we are seeing a trend here. Pepsi, 47%, S&P 86%. However, when we do extend it over the last 10 years, what you will in fact note is the performance isn't that far off, 162 versus 176. And what you can see on the graph is that at some points in the historical performance, Pepsi has been trading higher than the S&P. Now, let me know your thoughts below. 1, whether you like this analysis as part of our future episodes, and 2, whether or not you do believe over the longer term, PepsiCo will outperform the S&P 500. Now, let's jump into any insider movement. Now, percentage-wise, 0.14% ownership What we know, 2 insiders selling around 9.06 million, and this, remember, is over the last 12 months, with the latest sale being in fact 1 million in quarter 2, nothing in quarter 1, around 8 million in quarter 4. So no insider buying to note, quite heavily insider selling. And when we do take a look at who this was, we in fact see the CEO on the 9th of May, so not too long ago, sell over 5,600 shares, a price around $178, so higher than the current trading price, and as we can see, $1 million. Now, I don't think this is really relevant given it is far outdated, the 10th of October, but we also see the CFO sell just under 50,000 shares for around $8 million. Again, let me know whether or not you include this in your analysis, whether you see this as bearish, but realistically, with these insider sales, we don't know why they sell. It could essentially be a personal or financial reason. Typically, insider buying is, however, bullish, as they buy because they believe the share price will go up and they are privy to that information. Of institutional ownership, 73%. We know 28 billion worth of sales over the last 12 months, but we know there's a significant amount more worth of buys over the same period. However, now having said that, we actually know in quarter 1, the most recent quarter, a significant amount more of selling than buying, just under 10 billion versus just over 2 billion worth of buys. Now remember, always do your own due diligence, never copy what the insiders, institutions do, but this information is just here. So to wrap up, insiders have been selling over the last month. We also know institutions have been selling more over the more recent quarter, but in fact we can see a lot more buying over the last year. And to be fair, the majority of this was in quarter 2 of 2023. Now also, just to let you know, we have released our latest free weekly article, 12 undervalued dividend stocks, high quality companies. Free article, do click on the pinned comment below, you gain instant access to read. You can also take a look at all these other articles, how to find undervalued stock for those that are interested in the websites and resources we use to find undervalued stocks to buy. Now in terms of dividend safety, 93 score, so very safe. Market cap just over 200 billion, is a mega cap company, and we can see it was reaffirmed last month that the dividend is very safe, effectively meaning a dividend cut is highly unlikely. Now, last recession, so the Great Recession 07-09, they in fact increased the dividend. They had flat sales during the recessionary period, remember above the S&P, which was negative 12, but they significantly outperformed the S&P, negative 35% for PepsiCo, S&P negative 55. Dividend growth with this company, you typically get high single-digit increase like we saw in February, as well as the last 5 years on average. Over the last 20, though, nice double-digit increases at 11%. And do bear in mind, they are a dividend king. They've increased those dividends for 50 years or more, as well as paying a dividend for the last 59 without a reduction. Now, in terms of dividend yield theory, do remember this states a company is undervalued when the current yield sits above the 5-year average. We have one severe sign of undervaluation, 3.26 versus the 5-year average, as well as an undervaluation signal on the forward PE, 20 versus 24. Just bear in mind, we don't look at any of these models in singularity and will conclude towards the end of the episode. Consumer staples, however, sector P does sit lower at 18. So first things first, we do want to look at the free cash flow payout. Remember, this essentially shows us how much of their free cash flow management are paying out as dividends. And what we note here, below 70% if we want to be consumer specific. Personally, though, I use around 60% as a blanket rule. Earnings, remember, susceptible to manipulation by management through accounting, but the information is there. Now, what we do know is what I would consider a red flag indicator, essentially from 2022 and 2023. The dividend payout is very high, triple digit. What this means in 2022, management paid out more in dividends than they generated in free cash flow. Positive to note, in 2023, it did lower. However, it is still very high at 86%. A little bit more positive news, if they are able to execute, is over the next 12 months, they do anticipate this to come down to 75%. Definitely something I would say just to keep an eye on, as even though the dividend safety score does look good, this is one that could get out of hand depending on that free cash flow payout moving forwards. Free cash flow itself, though, we do like increasing free cash flows over the longer term, as well as the consistency. With PepsiCo, we do know, whilst it has increased from 2014 to 2023, very inconsistent year on year, so do bear that in mind. 2024, though, we are anticipating an increase to around 727. In terms of sales growth, now we did look at this numerically, now we have it in a percentage format. From 2019, it has been fairly strong, around the 3 to 7% level. Prior to that, it was very weak. Something to keep an eye on, especially the trailing 12 months showing 4%. We do want to see, at a bare minimum, that inflationary increase. Otherwise, in real terms, they do effectively start losing or reducing that revenue. Numerically then, we have this from what we looked at earlier. One thing that is nice, they do return excess cash. We do see those share buybacks over the last 10 years, 1.53 to 1.38. Nothing massive, so this isn't something that they are going to continue to reduce at a very rapid rate. In fact, as we can see here, there are some years where they actually do nothing with those shares outstanding. ROIC, as always, 10% or more give us faith management are able to effectively allocate their capital, 12% or more for industry specific. They are very consistently around the 19 to 20% level, so that makes it very attractive for investors or potential investors who do want to grab some shares of this company, depending on that price and that margin of safety. Operating margin, pretty much around that 16% level that we do want to see. As we can see, 15% in the more recent year. Same to be said for the free cash flow margin, although we do see it reducing from 2014, so something just to bear in mind. Although as long as it is above that 7% level, then we are satisfied with this point. Net debt to EBITDA, then the earnings before the interest, tax, depreciation, amortization, below 4 for consumer staples. These are effectively the number of years it would take the company to pay off all of their debt net of cash on hand, and correlates to balance sheet strength, dividend safety. 2.03 in 2023, nice to note. In fact, from the highs of 2020, it has started to come down, and even better to note, 2024, they're anticipating this to come down to 1.87, so it is on the right track. The only thing I would keep an eye on is that free cash flow payout, as it has been triple digits just over the last 2 years, but overall their net debt to EBITDA is moving in the right direction, so this is a positive sign. So let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button, so you are continually notified of these videos as they drop. First model that we're using, the multiples valuation model. Companies, we analyze their P multiple with the average P multiplying by the EPS of Pepsi to get an intrinsic value showing some nice undervaluation. 187 intrinsic value versus 166 market price, but do bear in mind we're not looking at any of these models in isolation. We then move on to the dividend discount model, the yearly dividends. We have the average growth rate just over 7%. Growth rate estimated around 5.25. We do want to be a lot more conservative, so we have gone for below the average as well as essentially below the more recent increase. This does give an intrinsic value showing significant upside, $207, as we can see here, undervaluation. We then move on to the DCF model. We have the free cash flow year on year. Average growth rate around 2%. Forward-looking, analysts do target around 12 to 14%, so we have gone a lot more conservative at 11, and it is also lower than the more recent increase. And as we saw earlier, they are anticipating a large increase into 2024. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get the equity value, divide by shares outstanding, and as we can see here, an undervaluation signal. So we have 3 undervaluation signals to get to our intrinsic value today, and in the episode we do get to a value of $191. Do bear in mind you can grab a copy of this model by clicking on the pinned comment below, running through examples in your own portfolio or on your watch list to get your own acceptable buy price. Margin of safety then, we do start with 10%, which we only execute if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that for PepsiCo, it is a buy up to $172. Then we keep going till it's near the current trading price. 15%, it isn't too far off, but we don't see that level just yet, so it is trading around a 10 to 15% MOS level based on the estimates and judgments today. Now, in terms of Wall Street and their forecasts over the next 12 months, they do see some upside of around 14%. Their price target $189, not too far off our intrinsic value. Now, this isn't one that we are looking to add just yet with this margin of safety. We would like to see a much larger MOS level, at a minimum around 20%, so around the $153 mark, before we do start dollar cost averaging in. For those that are looking for a larger MOS level, well, 25% would be around 143, but as we said in today's episode, it is around a 10 to 15% level. As always though, do let us know your thoughts in the comments below. Is this one that you're looking to add on the watch list now it has started to drop? Maybe this is one that you're looking to buy, or maybe for whatever reason, do let us know this is one that isn't on your radar for 2024. As always, if you've enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.